Welcome back to the GMS Weekly Ship Recycling Market Insight Podcast. It's week 50 of 2025, and I'm Ingrid.
And I'm Henning. This week's headline is December Downers, and it fits. Inflation is creeping up again. Plate prices are sliding in the wrong places. The US dollar is still squeezing local currencies, and both freight and oil soften together.
The wider market picture set the tone. The Baltic Dry Index fell by nearly 4% to its lowest level in about a month. Capes were down about 5.6%, Panamax slipped 2.1%, and the smaller segments eased by around 16 basis points.
Oil did not deliver the $60 moment either. Futures retreated more than 3%, closing around $57.61 a barrel, with the supply glut narrative back in focus.
And when freight and oil roll over at the same time, demolition sentiment rarely gets a boost. Add in a stronger dollar and softer steel, and end buyers naturally take a step back.
That's the big theme heading into year-end: festive decline, cheap green sales, and stubbornly thin supply. And at the doorstep of 2026, across most subcontinent locations, levels are increasingly sitting at, or below, the 400 mark.
Let's start our regional look with Bangladesh.
Chattogram has been at the forefront recently. A busy November with a raft of green, Hong Kong convention-only LNGs to select yards, 4 in total, plus a mini Cape and an MR tanker.
But that activity came with a price. Several green units have gone in cheaply over recent weeks. And those below market levels have pulled sentiment down not just in Bangladesh, but across the subcontinent.
Exactly. Even though Bangladesh has remained the top-ranked pricing destination for about 2 months, local recyclers saw no reason to hold offers up while fundamentals turned against them.
On the fundamentals, the currency barely moved, down just a single basis point. But local steel plate prices did the real damage. They fell about $9 a ton, dropping from just above $502 to the high 493s.
And the domestic backdrop is getting louder. February 12th, 2026 is now confirmed as the next general election day, and we're already seeing rising political tension and instability as that date approaches.
Anchorage activity reflected the pause too. Just one mid-sized bulker showed up this week, suggesting yards are digesting recent deliveries and trying to reconcile where levels go next.
Moving west to India, Alang remains the discouraging story, and once again, it's the weakest placed of the subcontinent destinations.
The fundamentals were blunt. Local steel trading levels took another hit, down more than $7 a ton to around $377.
And the rupee was the bigger problem psychologically. It weakened again, losing about 65 basis points and closing at a record 90.50 to the dollar.
Inflation also rose from 0.25% to 0.71%, still low overall, but it adds to the wrong direction feeling when your currency and steel are both sliding.
One thing to watch is supply. If recycling candidates stay scarce for long enough, prices can stop sliding and start finding a floor. But right now, most buyers in India are defending levels, not chasing ships.
On to Pakistan, and the tone there is pretty clear, breathtakingly inert.
Despite the recent milestone, prime green recyclers becoming Pakistan's first Hong Kong convention ratified yard, Gadani has struggled to translate that into fresh business. Limited Hong Kong convention capacity and the DASR approval process are still major hurdles.
There was one notable operational moment this week, a bit of a surprise anchorage. A smallish unit opened in regional waters and ended up in Pakistan, likely because India would have offered lower levels, with a longer voyage and more expensive inward clearance.
Fundamentals were mixed but still heavy. Inflation eased slightly to about 6.1% from 6.2%. Steel plate prices flatlined at around $575 a ton after weeks of pressure from cheaper Iranian imports.
And the Pakistani rupee stayed steady, ending the week around 280.35 to the dollar.
The bigger structural issue remains visibility and compliance. As scrutiny on recycling destinations grows, Pakistan's lag on the Hong Kong convention spectrum could keep it underperforming, even if tonnage improves next year.
And finally, Turkey.
Aliaga stayed steady but quiet. The lira slipped again, down about 26 basis points, ending around 42.70 to the dollar.
Import and local steel plate prices stabilized, but the higher levels reportedly brought in no new tonnage this week. Bottom line, it's a slow finish to the year. Viva 2026.
Pulling it all together, the GMS rankings this week keep Bangladesh in the lead, but sentiment is weak.
Indicative levels stand around $410 per light displacement ton for bulkers in Bangladesh, $430 for tankers, and $440 for containers.
Pakistan follows at about 400, 420, and 430 respectively.
India trails at roughly 380, 400, and 410.
And Turkey rounds things out at about 270 for bulkers, 280 for tankers, and 290 for containers.
Those are, of course, indicative numbers in an extremely quiet market. When sales are scarce, one low-price deal, especially a cheap green sale, can shift the entire tone.
Before we wrap, this is typically the quietest stretch of the year. Fewer working days, slower decision cycles, and buyers protecting levels.
So the theme remains: softer freight and oil still under pressure, currencies volatile, and thin supply, with Bangladesh still taking the business as we head into the new year.
That's it for this week's weekly ship recycling market insight. For the full written report with tables and port positions, download it directly from the GMS mobile app or subscribe to our newsletter to get it delivered to your inbox every week.
Thanks for listening. Stay safe, and we'll catch you again next week with another market update.